My name is Behring. I'm the CEO of Behring Co. in Behring Regional Center, a vertically integrated real estate development, investment, and immigration firm. Essentially, acquisition to exit, I-526 to 829, you're talking to the same firm, quality control up and down the entire scale. We mostly focus in the San Francisco Bay Area. We like residential and mixed use, master plan communities, things of that sort. We've been in the industry since 2013, relative success, 100% approval histories across the board, no denials. No projects ever failed. Every single eligible investor that got to the 829 phase and sustainments have been repaid. Done a good job and deeply care about the EB-5 program. And based off the conversation today, you think we were a litigation firm, but it wasn't intended, but it happened. But sure glad to be here today with everybody.
On the issue of project selection by asset class in the current environment, with where interest rates are and recessionary pressures, maybe you can tackle that.
With everything that we've looked at, interest rates run our world. You're talking about cap rates, rates of return, the cost of debt, cost of capital, all the expectations change entirely when you get a significant change in interest rates. EB-5 is no different than the traditional investment environment. We look at EB-5 as if it's some sort of voodoo, like it changes the rules. When you talk to an investor, they'll ask about things that they think are going to protect them in their journey to signing on for an EB-5 investment. They'll ask you about how many approvals do you have, how many I-829s have been filed and all this, and they need to be going back to asking about the actual underlying investment. What is that investment going to do in an adverse environment, in a terrible economy that may or may not occur during the lifetime of your deal? And a lot of us and all of our past investors, they're not in and out of this thing in 3 years. They're sticking around for 5 years, 6 years, some 7 years, and for some people, you might creep into double digits. You need to be ready for multiple cycles to pass throughout the life of your investment. And for us, we historically have been a master plan communities or residential, multifamily, urban infill. I am very much a supporter of urban for EB-5, and I'm biased. And the rural changes for the RIA and all those kind of things, I understand why it had the support, but I do not believe that a guy that wants to go, or girl, anyone that wants to go to work that happens to live in an urban area, that their job is somehow worth less than a rural one. And why we had to pick winners, I don't understand. But that's a whole conversation for a different time. But urban and looking at interest rates and asset class, we just went through COVID. There are certain asset classes that were extremely sensitive to it, but it wasn't something that was predictable. The interest rates going up because we started printing trillions of dollars, that was predictable. And when you have interest rates that are going up, you're gonna have a couple asset classes that are not going to do well, period, full stop. For sale residential, you need to buy homes, you need debt. You need to get mortgages. If your interest rate is now 7.5%, it was double what it was 8 months ago, for sale residential is going to have a problem. If people now have super high cost of capital and you're a company and you're no longer thinking about joining every single event or conference or whatever, flying people around, staying in really nice hotels, you're maybe not gonna eat at 5-star restaurants, the retail apocalypse, you're gonna watch out for malls and their cost of capital. But no matter what, you need a place to live. And that's multifamily residential, that's affordable, relatively affordable for the market, and you want to see urban. Because for us, as a traditional investor, and we don't change our philosophy just because it's EB-5, everything stays the same, our underwriting is the same. It needs to have center of gravity, it has to have economic depth, economic diversity, so there's more than one thing driving that local economy. If you are in the middle of San Francisco or New York, there are a lot of people going to work, doing a lot of different things, and that whole economy and the housing that's in it is gonna be supported by that. If you are in a much different location that happens to be rural, and there is no economic diversity to what drives that location that you're at, if it happens to be a luxury resort that only does skiing, for example, whatever it is. If it doesn't snow, or people don't travel to that location for snow that year, they are in trouble. There's nothing else coming to save them. But for multifamily residential, urban cores, economically diverse, you have a chance of doing really well in a lot of different economic scenarios. Then, last thing, the exit. How deep is the buyer pool for that specific asset? If you've got a highly customized facility in the middle of nowhere that only one guy knows how to make widgets for and run and be successful financially, who does he sell it to? How do you get out in the event that that group doesn't want to use said facility anymore? Multifamily residential building in an urban core, fully stabilized, renting, cash flowing like a bond. There is several thousand people and institutions, pension funds, insurance companies, high net worth family offices. There's 1,000 people that will buy that cash flowing asset because it just means money. So the depth of the exit, the depth of markets, the support, the reasons we acquire it, then you talk about asset class, residential, it's simple to build. It's not complicated. There's a lot of people that can build it. If it's a very, very sophisticated, very unique endeavor that's in construction, something that's a one-off, there might only be one general contractor that can build it. And if that guy, for whatever reason, or girl, anybody doesn't perform and you need to replace them to build a very unique item, you might have a whole different problem altogether. You want to build a 3-story walk-up apartment building? There's a couple people that can build that building really easily. And you're going to be able to weather change and or swap people out if they're not behaving. You can manage that start to finish. You can protect yourself. So that's why we do what we do. And when we're talking about underwriting, like what people need to be aware of is that just because we have this EB-5 tag on all these deals, it didn't change anything. And if you have a good deal and a good asset that's doing what it's supposed to be doing, it satisfies all the EB-5 requirements without even thinking. The job creation's there, the investment's there, sustainment, all of these little rules that we focus on, and we have lots of panels discussing on what's real and what's not, they actually happen automatically if you have good people running a good asset. EB-5 is a lot easier than you think, and that's the only reason that we have 100% approval history. The secret is that EB-5 is not that hard. Just do good projects with good people, and it'll work out itself. So, interest rates, you look at the asset classes, the ordinary market, the capital markets will tell you exactly what that asset means to them with set rates. There's no secrets.
I would say though that you're right, from a developer perspective, EB-5 is no different. But if you think about it as a fund, right, like a private equity fund for a moment, the way you operate the back office is different, right? Because then that's why it gets to sort of the fund administrator. EB-5 is a private equity fund mashed up with a immigration program, mashed up again with a job creation program, right? And those elements are important to have built into your operational infrastructure for the investor to have success. So I agree with you from a developer perspective, 100%. If you focus and get the right deal and you get it done, the jobs will be created. But if you don't have the right operating infrastructure to do all the tracking and compliance and everything else, you can get into trouble. And we're finding—
Are you talking about path of funds, like the transactions?
When money moves, do you have the audit trail? Do you have all the evidence that ultimately the law firms are going to need to file the petitions? Is all that stuff in place, in addition to producing the financial statements and those kinds of things?
Yeah, so I would say, though, that the difference with that kind of back-end administration, and we talk about path of funds, so every single transaction, every single bank statement that comes through, you want to track everything all the way up to 800,000. We do already do that.
Right.
That is something that's normal because for us as a vertically integrated developer, and we have multiple product types, we're not just in like the debt bucket where it's very, very nice to have access to low cost capital for mezzanine debt. However, we do common equity, and we do preferred equity, and we have sophisticated waterfalls. There's multiple tiers and things like that. And in order to calculate that waterfall for those LPs, the traditional common equity, we still have to pull every single transaction to run it through the waterfall, calculate preferred returns, and that's to the day. Like the day you contributed, the money went in, you're burning the pref, and then all of a sudden you have carried interest and everything else. So it was very similar. So however, it does overlap, and we had fund administrators before RIA because it made that part of our life really simple. So if you're running an institutional quality deal in an institutional quality platform, a lot of the RIA was actually in place.
Yes. All of the folks here have impeccable track records in the space, but they also rely on other partners, companies like us, leading law firms, economists, business plan writers. And so I would say maybe an easy thing to do in due diligence is to figure out what team these folks have put together, because that makes a difference. And then, I've heard the term EB-5 3.0 today, so maybe it's a little bit of a gold rush and there's lots of new people coming in. So make sure you understand who the A players in the business are, and that'll save you a lot of trouble.
Yeah, and to add on to what you just mentioned is, something in, like we do a lot of prop tech investment, a lot of other technology-based things, and it's the concept of an ecosystem and a platform.
Yep.
And you guys specifically are a platform, and you guys do it so well that you probably are qualified to fulfill all of our FOIA requests just through your own data. So with 800 EB-5 projects, you're probably a faster source of information than USCIS.
There's some truth to that, yes.
Yeah, so I'm sure you unfortunately can't share any of it. So anyways, with the idea of the platform, and that's probably the one thing that I really wish we had an opportunity to spend a lot more time on with investors when you're talking to them, because it's a deeper conversation where you can think about like you're shopping for EB-5 projects, but you really need to be looking at platform, and that's people, that's the technology that they use in order to administer all of the funds. If you want information, go call this like third-party accountant. They're handling your stuff. Are they just going to quit? Or is this like a part of their daily life, and they're going to be there in full force, in full support from beginning to end? And EB-5 is a part of our ecosystem, and it's really important to us. And it also fits really nice with everything that we already do. So it's not hard for us to support EB-5, and it's something that falls into the rest of our fund management, investor relations, and our retail operation, our retail investors. It fits nicely. So when you're really on the phone and you're looking at EB-5, like you are picking partners, not projects, because with the world of retrogression and timing and processing times, things like that, that project that you pick might actually be the first of 2 projects, 3 projects, 4 projects, but the RIA also is addressing a little bit of that, where retrogression and redeployment might be a thing that changes significantly. But in a world past, you definitely want to pick the right partners, because that first project that you have, and especially even the one that we presented today, it's nearly done. It's 35 floors up out of 39, and like you're not going to spend the entire duration in that construction period. That construction will end. But if you like the people, you like the platform, you like what they do on a daily basis, and in worlds past when there was redeployment, if we had redeployment, it was going to be more of the same. There's going to be another apartment building in the San Francisco Bay Area or Silicon Valley. Like you signed up for a product type done by experts that live in that world. We don't bounce around to geographies. We don't bounce around to different asset types. If you signed up for a multifamily apartment building, you're not going to be thrown into something entirely different across the country in a place you didn't pick. So, what you see is what you get with our platform and our people. And then with our name on the wall, we're not going to just quit or get fired or transfer over where like the people you signed up with disappeared. And like in the construction world, you lose 3 teams or 4 teams of general contractors, and the people that you cut the deals with to build the building and trust them to deliver it, and they're gone. With the regional center, for us, like we bought in for the long term, and that team will remain intact. And that's why the continuity of the executives is really important too. Have they worked together for a long time? Have they have success together? Or did the person just show up and they're brand new and you have no idea when they're going to take the next job? So like you're doing a full interview process on this thing, and the people are way more important than the investors give it credit for, because every question they ask on the phone when that first call is really like, how many approvals do you have? How many 829s? Like have you ever repaid somebody? It's like, okay, well, those things are nice, and like, here's the stats, but here's some other things you might want to ask about.
Before the COVID and the shutdown, right, the trend had been average size of project was going down. In 2013, the average project was $100 million of EB-5 capital. By 2019, it was down to $25 million of EB-5 capital. Now, shockingly, right? Post-COVID, game back on, the average right now is $70 million of EB-5 capital. Now, the folks sitting at this table here, right, can raise $70 million. As Sebastian said, maybe it doesn't matter if they only get the $50 million, but Can-Am can raise capital, Behring can raise capital. So what are these other folks doing that are saying they're going to raise $70 million in these markets, right? It's something to be very careful about, and how dependent is it on that? Because we were not seeing that average capital amount being raised before EB-5 3.0.
But that's what Sebastian was mentioning, the importance of that bridge financing to mitigate the EB-5 risk, because they are individuals. It is that $500,000 tranche, now 800. They're coming individually, one by one, different days, different time, maybe never at all.
Yeah.
And for one person to commit to you, that's they're entrusting you to take them all the way to the end. And if you only raise 500K, it's really expensive to manage that 500K for the next 10 years by himself. One tip that I would give every investor when they're first getting into this is to ask a lot of questions to people that live on different sides of the deal. Yeah. So your ecosystem for EB-5 is going to include the project. There's developers out there that might be the same. It's going to be immigration attorneys, all that kind of stuff. The immigration attorneys know everybody. There's a very, very, very established group that we saw just about everybody today. They know the regional centers. They've known some of these guys for decades. And they can also give you intel on how people react when things get adverse. Will they protect the investors? Like, what's an example of a deal where they had to pivot and they did something where they did the investors a solid? Making something work because a family trusted you, that's a big deal. So kudos to you guys for doing that. And one of the items that we had to do was changing the 829 language to allow individuals to exit rather than an LP that was underwritten and documented in 2013. Yeah. Every 829 needed to be approved in order to exit. And then you have some people that are 10-year retrogression, and then you've got a South African that's done. And you're asking him to stick around for the next decade? We amended the 829, or all of our limited partnerships and everything to respect the investor and not bulk everything, because USCIS left us off the hook to not have to do that. So, that for that individual where, he needed to exit and he had things in life that he needed to spend that money on, and it ended up being a good thing for everybody. The other thing I would say about due diligence, and something that's useful for anybody, is you have the ability to verify things that are being told to you. And it's usually in a document. Whether somebody's talking about cost or schedules, or they're telling you something that is materially influencing your decision to move forward with investing. And there will be a document somewhere that will verify that. Too many people will just listen to what they were told and say, oh, okay, great, and then they move on to something else, but they didn't actually verify. And they didn't look at a doc, or they didn't try to triangulate through a different party or whatever it is. If they tell you they have a certain amount of sales of something, it's recorded. For residential, it's public knowledge. It's public record. You can see if sales are being recorded. And if it's something on the construction side, and you can see, it's like, we're under construction. There's a draw every month. You can see exactly how much money we spent. How many jobs were created. It's like, okay, it's RIMS 2. You got the budget. There, boom, we got jobs. And it's verifiable. So if somebody's telling you, well, we finished X number of jobs, this is a lower risk scenario than otherwise would be, it can be verified. So you don't have to, it'd be nice to trust, but verify. So the documents are out there, the proof is out there,